The system isn't overheating, it's rewriting the rules in real time. Markets are flying while the real economy is tightening. Valuations look unstoppable while the engine underneath them is running on hope and liquidity instead of production. And if you think this is just another bull market story, notice the number that should terrify you. The stock market's total value compared to GDP has now crossed 200% in the United States. That's not expensive. That's historically thin ice. Because once prices stop reflecting reality and start reflecting belief, the entire system becomes a dopamine loop. Dream earnings, comforting headlines, and a growing assumption that the Fed will always catch the fall. Now watch how fast this escalates. Another valuation gauge, CAPE, suggests the US market is still priced about 110% above its long-term historical average. That means investors are paying double for the same underlying value and calling it normal. But here's the part nobody is saying out loud. When a financial system runs on belief, it doesn't break with a warning. It breaks when liquidity blinks, and the blink is already forming. Right now, you're not watching a rally, you're watching the first stage of a global financial power shift. The question is, what's the trigger that forces reality back into the price? The event that turns confidence into panic? The moment that changes everything? America's financial structure isn't being attacked from the outside first, it's being eaten from the inside, because behind every record valuation is the same fragile assumption: the government can always borrow forever, at any scale, with no consequences. But here's the hard number. US public debt has now crossed $37 trillion, and the system isn't just carrying it, it's feeding it. The United States is now spending more than $1.2 trillion a year just on interest payments. That single expense is already larger than the defense budget, and it consumes more than half of total federal revenue. This is where the story flips. Because once a country is borrowing to pay interest on old borrowing, it's no longer funding growth. It's funding survival. It becomes a loop, a trap, a machine that can't stop. And the worst part is the numbers don't cooperate. Real GDP growth sits around 4%, while debt is growing 8 to 10%. The economy isn't catching up, the debt is outrunning it. Notice what that implies. This isn't a debate about too much spending. It's a mathematical cliff, a compounding spiral, a future where the only options become brutal: default loudly or devalue quietly. And if you're holding assets in US dollars, that quiet option is the one that finds you first. Now watch how fast this escalates, because the moment confidence cracks, borrowing gets more expensive, and the machine accelerates into something it can't control. Here's why the US can keep doing this longer than anyone else. It doesn't just borrow in dollars, it borrows in the world's reserve language, and that gives it a superpower most countries don't have: the ability to export pain outward instead of absorbing it at home. This is the mechanism people feel but don't name. When the United States prints money at scale, like the M2 supply surge of roughly 40% from 2020 to 22, it doesn't immediately detonate inside America alone. A huge portion of that excess flows through global trade and global reserves. Other countries hold dollars to settle commodities, to stabilize their currencies, to keep banks liquid, to keep imports flowing. So America prints paper and receives real goods, real labor, and real resources. Notice what they didn't deny. This is an invisible tax on the entire planet. But here's the part nobody is saying out loud: that privilege only works as long as the world agrees to absorb it. And that agreement is cracking. When US inflation hit 8% in 2022, the highest in 40 years, the Fed was forced into defense mode. Rates rise, liquidity tightens, confidence starts slipping, and suddenly the system reveals its weakness. If money isn't cheap, the debt machine isn't manageable. This is where the story flips again, because if America can't export the pain, it has to import it back home. And once that happens, the crisis stops being a market story. It becomes a currency story, a power story, a trust story. To understand where this goes next, you have to look at how reserve empires actually die, not with explosions, with a quiet rerouting of trust. The dollar didn't become dominant by accident. In 1944, Bretton Woods anchored global finance to the US dollar and tied it to gold. Then in 1971, the rules changed overnight. Nixon cut the gold link, and the dollar became pure trust, fiat paper backed by confidence and American power. That should have broken the system. Instead, the US built a new anchor, the petrodollar, oil priced in dollars, global energy demand forced into dollar demand. This is where the story flips, because history is cold. No currency stays king forever. The British pound ruled the world, then it declined after World War II when the empire lost production and strength. And the same structural weakness is now visible in the US model. America is no longer the uncontested factory of the planet. Production has shifted east, and if you don't control production, you can't hold monetary dominance forever using habit and military credibility. Notice the pattern. Reserve currencies die after the real economy relocates. And when that happens, the collapse doesn't look dramatic at first. It looks bureaucratic. It looks like trade agreements, payment rails, quiet diversification. It looks like the world slowly building an exit door while the headlines keep pretending nothing changed. Now comes the move that may have triggered the countdown, because the fastest way to weaken a reserve currency isn't inflation. It's turning it into a weapon. In 2022, the US froze more than $300 billion of Russia's foreign reserves. That wasn't just punishment, it was a demonstration, a signal to every government on earth. Your wealth can be turned off if you fall on the wrong side of Washington's system. Notice what they didn't deny. Money stopped being neutral. And this is where the story flips hard, because every central bank has to ask one terrifying question after that moment. Are our reserves actually safe, or are they conditional? You don't need ideology to react to that. You just need survival instinct. So the world started adjusting quietly. China reduced its holdings of US treasuries from over $1.3 trillion to roughly $770 billion, the lowest in 15 years. And alternatives began accelerating. Payment systems outside SWIFT, like China's CIPS and Russia's SPFS. Now watch how fast this escalates. Because once a reserve currency becomes a political switch, every country starts building backup power. And backup power eventually becomes a new grid. Here's the part most people still don't realize. This shift isn't being led by speeches, it's being led by structure. The BRICS bloc, Brazil, Russia, India, China, South Africa, and now expanded members like Saudi Arabia, Iran, and the UAE, is building an alternative gravity field. Their combined output is now over 40% of global production by purchasing power parity, surpassing the G7. That's not symbolic. That's mass, and mass pulls systems into orbit. Their goal is simple: trade and settle without automatic reliance on the US dollar through internal rails like BRICS Pay or direct bilateral settlement in local currencies. But here's why this becomes dangerous fast. BRICS doesn't just represent money, it represents resources. Energy from Russia, Saudi Arabia, Iran, manufacturing and labor from China and India, raw materials from Brazil and Africa. Now watch the contradiction. The US dollar is powerful because it's demanded. But if key commodities begin trading in non-dollar settlement, that demand falls. Not in theory, in mechanics. Russia and China have already shifted much of their bilateral trade into local currencies. And if that spreads, the US loses its cheapest funding weapon, global forced demand for dollar debt. What happens if this continues? It doesn't need a crash, it just needs momentum. Now zoom in on the quiet signal that screams louder than any headline: gold. While mainstream news praises fiat stability, central banks are buying gold like they're preparing for a storm. For 4 straight years, official purchases have exceeded 1,000 tons per year, with China and Russia leading. That's not speculation, that's preparation. Because gold has one property no fiat currency can offer: neutrality. It can't be printed, it can't be sanctioned, it can't be frozen by a political decision. But here's the part nobody is saying out loud. When central banks hoard gold, they're not betting on profit. They're betting on redesign. They're preparing for a future where money has to be anchored again, either directly or indirectly, back to something real. And one scenario keeps showing up in analysis circles: a radical repricing of gold to extreme levels, like $10,000 to $20,000 per ounce, as a way to reset balance sheets and erase debt pressure. If that ever happens, the wealth transfer isn't gradual. It's violent. It moves value away from paper claims and toward physical ownership. And the people who realize it late don't get a second chance to reposition. Now here's where the story gets even more unsettling. It isn't just nations preparing, private capital is moving too. Chinese giants like Tencent and Baidu have started doing something that signals a long-term bet against dollar strength. They're reducing USD borrowing and issuing debt in yuan instead. Panda bonds. This isn't nationalism, it's cost and expectation. Yuan borrowing can come at around 2.1% interest, compared to 4-5% in USD. And if you believe the dollar weakens over time, borrowing in your own currency becomes a strategic shield. Here's the concrete shift. Offshore yuan bond issuance has tripled from 2021 to 2024, reaching nearly $200 billion. That's not a curiosity, that's a wave. Now watch how fast this escalates. Because smart money doesn't wait for the collapse to be confirmed. It moves during denial. And there's another sign. From 2025, foreign investment flows into Chinese bonds, and equities have turned positive again after a period of withdrawal. That doesn't mean China is safe. It means investors are looking for alternatives to a US market priced like it can never fall. And when capital starts treating America as one option, not the default, the entire monetary hierarchy starts shifting. Now bring it back to you, because this isn't just global chess. This is the pressure system that decides whether your life gets easier or harder. When the dollar system is stable, prices are predictable, capital is cheap, and opportunity spreads. But when a system runs on money creation and debt expansion, the pressure doesn't disappear. It transfers. And it hits ordinary people first. Inflation doesn't feel like macroeconomics. It feels like being punished for being normal. Rent rises, food rises, fuel rises, savings lose meaning. And inside the US, the cracks are getting visible even at the state level. At least 7 US states have passed laws allowing gold and silver to be used as legal payment. Notice what that signals. That's a quiet rebellion against the federal monetary system. Not because people are conspiracy-minded, but because they're looking for protection when trust gets unstable. And this is where the story flips again. Because a financial crisis doesn't stay financial. It becomes social. Then political debt ceiling fights stop being about discipline and start being about power. Shutdown threats become normal. Fiscal policy becomes a weapon. If this feels familiar, say so in the comments. Because the system always shows its true face when people stop believing in the currency that runs their future. Here's the systemic insight mainstream news won't say cleanly. This isn't random. It's a controlled compression. When a country reaches debt levels it can't unwind, it has 2 strategies left: inflate the debt away or redesign the money itself. And that's why the reset scenario keeps appearing in serious analysis. A crisis could be allowed, almost engineered, to wipe out the old structure and justify the installation of a new one. This is where the story flips, because once the system pivots into digital control, you don't just get new money, you get new rules. A central bank digital currency CBDC would allow full tracking, direct policy enforcement, potentially even negative rates, and the slow removal of cash as an escape valve. But here's the part nobody is saying out loud. In a reset, assets don't disappear. They move. The losses concentrate on paper holders, stocks, bonds, deposits, while real assets consolidate into the hands of those positioned early. It's not a glitch, it's a feature, a system designed to maintain power through transition. And once you see that mechanism, the story stops being about markets. It becomes about control, about who gets protected and who gets priced out. So where does this go next? Two paths, both dangerous, both plausible. Path one is managed decline. The dollar stays dominant, but stability becomes a policy project. More debt, more intervention, more dependence on valuations staying high, and more inflation risk every time the machine needs another rescue. It doesn't collapse, it deteriorates. And you feel it through living costs, credit tightening, and a society that gets angrier without knowing exactly why. But here's the part nobody is saying out loud. That path only works if the world keeps absorbing the cost, and the world is quietly preparing not to. Path two is the structural break, not a dramatic crash, a slow shift in settlement patterns. More regional trade, more local currencies, more gold, less automatic dollar demand. And once that shift accelerates, the US must pay higher rates to attract buyers for its debt. That forces the Fed into a trap: tighten and break the system, or print and weaken the currency. Notice what that implies. The next phase doesn't need a villain. It only needs time, and the next move might already be forming off camera inside central bank decisions you'll never see on the front page. Here's the line that reframes the entire story. The petrodollar wasn't just an agreement, it was a cage. It forced global energy demand to become dollar demand, and it kept US borrowing cheap for half a century. But the cage is opening. Saudi Arabia has openly negotiated selling oil in yuan and moved toward joining BRICS. That's not just a diplomatic moment, that's a structural fracture. Because once oil is no longer exclusively priced in dollars, the forced demand for dollars begins to fade. And here's what that breaks next: the US bond market. For decades, oil exporters recycled their surplus dollars back into US treasuries, keeping American rates lower than they should have been. But if that recycling slows, capital can shift into gold, infrastructure, or yuan-based assets. Now watch how fast this escalates, because when the US loses its artificial demand engine, it has to pay real prices for real borrowing. Higher rates mean higher interest costs. Higher interest costs mean more borrowing. More borrowing means more money creation. And that feeds the very inflation spiral the system claims it can control. This is the loop, this is the trap, this is the shift. So the real question isn't whether the dollar dies tomorrow. It's whether the world is already building the world after the dollar. And if it is, then the biggest transfer of wealth in modern history won't happen during the panic. It will happen during the denial.